Look at these two price moves. At first glance, they look almost identical. Both create a swing low, push higher, and eventually form a swing high. But there's one detail that completely changes how we read them. The first move leaves behind a fair value gap. The second one doesn't. That difference tells us something important about the strength of each price leg. And this is where order flow legs become useful. They give us a way to read the directional bias behind a move. Identify which fair value gaps have the strongest probability of holding, and determine where price is most likely being drawn next. Then when we bring multiple timeframes into the picture, the analysis becomes even more powerful. A higher timeframe FVG can take priority over a lower timeframe setup, while a failed FVG can even become an iFVG reversal opportunity. Let's break down exactly how this works. Look at this bullish move. Price is consistently breaking swing highs and creating higher highs, while the swing lows are being respected and forming higher lows. That's bullish order flow. But there's another detail here that matters. Look at what happens every time price retraces. The bullish fair value gaps created during the impulsive moves are being respected as support. Price pushes through a swing high, it retraces, finds support inside the bullish FVG, and then uses that area to push toward the next swing high. Then the process repeats. The bullish FVG is acting as the internal swing liquidity area that supports the move, while the swing high becomes the external swing liquidity target. Now look at the bearish example. The same process is simply inverted. Price is moving lower, creating lower lows and lower highs. The bearish fair value gaps are being respected as resistance, and price uses those areas to continue delivering toward the consecutive swing lows. So when we talk about order flow, we are essentially describing the process of price delivering from one liquidity pool to another while remaining inside a trending structure. In bullish order flow, bullish FVG are respected as price works toward consecutive swing highs. In bearish order flow, bearish FVG are respected as price works toward consecutive swing lows. But here's where the real advantage begins. Not every price leg has the same strength. Look at these two bullish legs. At first glance, they look almost identical. Both have a swing low, both have an impulsive move higher, and both eventually create a swing high. But look inside the legs. The one on the left contains a bullish fair value gap. The one on the right doesn't. That difference is extremely important. The leg on the left is a bullish order flow leg. The leg on the right is simply a bullish price leg, and that means the left leg gives us a much stronger framework for anticipating continuation. So how do we define a bullish order flow leg? There are three criteria. First, we need a swing low that establishes the beginning of the bullish leg. Second, the move higher needs to be impulsive enough to leave behind a bullish fair value gap. And third, we need a swing high that acts as the immediate external liquidity target if the FVG is respected. Now watch what happens when the market retraces. With the order flow leg on the left, price has two levels sitting beneath the high. The first is the bullish FVG. The second is the swing low. Because price encounters the FVG first, it has an opportunity to find support there. If that happens, we can get another bullish leg targeting the latest swing high. But now look at the leg on the right. There's no fair value gap inside it. So when price retraces, there isn't an internal FVG available to provide support. The next obvious target is the swing low, and that's the key distinction. An order flow leg gives price an internal area from which the trend can continue. A regular price leg doesn't. That's why order flow legs have a higher probability of supporting a continuation move. Now flip the chart. The bearish version follows exactly the same logic. We need a swing high to establish the beginning of the bearish leg. We need an impulsive bearish move that leaves behind a bearish fair value gap. And we need a swing low that becomes the immediate external liquidity target. If price retraces higher, the bearish FVG becomes the first level it can interact with. If that area is respected, price can create another bearish leg toward the latest swing low. But if there's no bearish FVG inside the leg, the setup is weaker because price has no internal FVG to use as resistance. So now we understand what an order flow leg is, but knowing that isn't enough, because the real question is, which order flow leg should we actually trust? And this is where directional bias comes in. Look at this 15-minute chart. The latest order flow leg is bearish. Inside that leg, we have a bearish fair value gap. That immediately gives us a bearish directional order flow bias on the 15-minute time frame. Why? Because creating a fair value gap requires an impulsive move, and an impulsive move tells us where the market is currently demonstrating strength. So if the latest FVG created on this time frame is bearish, our directional bias is bearish. If the latest FVG is bullish, our directional bias becomes bullish. But there's an important rule here. This bias belongs to the time frame that created it. A 15-minute fair value gap affects the 15-minute order flow. It doesn't automatically change the directional bias of the 1 hour or 4 hour time frame. Each time frame has its own order flow narrative. Now, with our current 15-minute bias being bearish, what would we expect to happen? If price retraces higher, we would expect it to target this bearish FVG. If the FVG is respected, that area can become the catalyst for another bearish leg toward the swing low. That is our expectation based on the information currently available. But watch what actually happens. Instead of continuing lower, the market creates a new bullish leg. And although this new leg is smaller, it contains something extremely important: a newly created bullish fair value gap. That means we now have a new bullish order flow leg. And suddenly the chart has two conflicting narratives. The older leg is bearish. The latest leg is bullish. So which one do we follow? This is where many traders get stuck. They have already formed a bias, so they continue looking for shorts even though the market has just given them new information. But the rule is simple. Always prioritize the latest valid order flow leg. The newest leg is now bullish, so our 15-minute directional bias switches from bearish to bullish. Now we wait and see whether the market respects that new narrative. And eventually price retraces into the bullish FVG. It finds support and pushes higher. Once price breaks through the high created by that bullish leg, the order flow leg has completed its objective. This is an important detail. When the FVG is first touched, the target becomes locked at the extreme of the leg that created it. So if it's a bullish leg, we're watching the high of that leg. If price retraces into the FVG and then pushes beyond that high, the bullish order flow leg has successfully completed. But notice what happens next. Price eventually reaches the older bearish FVG, and it may actually react. This is important because a lower probability level doesn't necessarily mean zero reaction. There can still be unfilled orders sitting inside that FVG, so price may slow down. It may hesitate. It may even produce a small reaction. But because that bearish FVG conflicts with the current bullish order flow, we don't expect it to hold for long. The larger directional narrative remains bullish, and eventually price gets back on track. Now another bullish order flow leg forms. At this point, if price retraces, the latest bullish FVG becomes the first level we expect price to encounter. It could potentially act as support and become the catalyst for another move toward the latest swing high. But then something changes again. A bearish leg forms, and this bearish leg contains a bearish fair value gap, so we now have a new bearish order flow leg, and once again, the latest leg takes priority. Our directional bias switches from bullish to bearish. The bearish FVG becomes the higher probability area to watch, and the bullish FVG we were previously interested in is now lower probability because it no longer supports the current order flow narrative. This is the first major advantage of order flow legs. They stop you from treating every FVG on the chart equally. Instead of asking, can this FVG hold? You start asking, does this FVG agree with the latest order flow? But there's another problem. What happens when FVGs from different time frames are competing for the same price movement? This is where the magnet rule becomes critical. Look at this 1 hour bullish order flow leg. Price retraces lower, but instead of finding support inside the 1 hour bullish FVG, price completely ignores it. It pushes through the FVG. Then it takes the swing low, the 1 hour order flow leg. At first this looks like a major bearish signal. It appears the entire bullish setup has failed, but watch what happens next. Price suddenly pulls back higher. It moves straight through the 1 hour FVG that was just invalidated, and continues toward the original swing high. So why did the market behave like that? Zoom out. Just below this 1 hour order flow leg, there's another bullish order flow leg, but this one was created on the 4 hour time frame, and this is where the magnet rule comes into play. When multiple levels are available as potential targets, the higher time frame level has the stronger magnet. In this case, the 4 hour bullish FVGs was the stronger draw on liquidity, so price was attracted to the 4 hour FVG. The 1 hour FVG was disrespected along the way. This is why you cannot tunnel vision into one time frame. Your 1 hour setup can look perfect. But if a stronger 4 hour level is sitting below it, that higher time frame magnet can completely change how the trade develops. And this doesn't mean the 1 hour order flow leg was invalid from the beginning. It was still a valid 1 hour order flow leg. It simply had a stronger, higher time frame magnet underneath it. There's another detail on this chart that matters. Below the 4 hour FVG, we have another 1 hour bullish FVG. At first you might think, if price breaks the first FVG, maybe this lower one becomes the next support, but it shouldn't be treated that way. For price to reach that lower 1-hour FVG, it would first have to invalidate the 4-hour bullish FVG. And once the higher time frame FVG is invalidated, the hierarchy changes. The next major draw becomes the low of the 4-hour order flow leg. That means the lower 1-hour FVG is effectively overruled by the higher time frame move. So here's the practical rule. If multiple bullish FVG exist across different time frames, a lower time frame bullish FVG can only remain a valid support target if it is positioned above the relevant higher time frame bullish FVG. For bearish FVG, the logic is inverted. A lower time frame bearish FVG can only remain valid if it is positioned below the relevant higher time frame bearish FVG. Now this can create a problem. Sometimes you have multiple valid FVGs spread across a large price range, and if you enter before price makes its decision, your stop may need to be unnecessarily large. So instead of trying to predict which FVG will hold, let the market decide. This is one of the most important practical applications of the entire concept. Look at this example again. We have multiple potential bullish support areas. Rather than buying somewhere in anticipation, we wait for price to retrace. Price reaches the 4-hour bullish FVG, and this time it actually rejects. Now we have information. The higher time frame order flow leg has shown us where buyers are willing to step in. So instead of entering directly from the large 4-hour FVG, we can drop down to the 1-hour time frame and wait for a new bullish order flow leg to form from that reaction. Now our entry can be much tighter, and there's another advantage. The lower time frame bullish order flow leg is aligned with the higher time frame bullish order flow leg. That means we're no longer trading against the larger structure. We're using the lower time frame to enter in the same direction as the higher time frame. And because the higher time frame leg is supporting the trade, we can potentially extend our target toward its external liquidity. That's a much more valuable setup than simply buying the first FVG we see. So whenever possible, look to trade away from FVG, not blindly toward them. Let the higher time frame FVG produce the reaction. Then use the lower time frame to confirm the new order flow leg. Now let's add another layer of confluence. Look at this bullish order flow leg. Before the leg formed, price had attacked a higher time frame liquidity level, then it reversed higher. During that move, the market also created a bullish CISD. If you're familiar with CISD, you know it can be used as a level for identifying a shift in directional momentum. Here the bullish FVG overlaps with the bullish CISD, and that creates a much stronger support zone. Why? Because price has two overlapping reasons to potentially reject higher. The first contact is with the bullish FVG. If price continues deeper, it reaches the bullish CISD. Instead of relying on a single level, we have confluence between two bullish areas. The bearish version works exactly the same way. A bearish FVG overlapping with a bearish CISD creates a stronger resistance area and increases the probability of a bearish reaction. But there's another criterion we want to see. Ideally, the new order flow leg should originate from price respecting a previous FVG. This creates what we can think of as order flow leg layering. It can happen on the same time frame. But the setup becomes even stronger when the new lower time frame order flow leg originates from a higher time frame order flow leg being respected. Now we have alignment across time frames, and that brings us to one final application. Order flow legs aren't only useful for continuation. They can also help us identify reversal setups using inversion fair value gaps. Look at this 4-hour chart. Price has just attacked an old swing high. That swing high is currently acting as the draw on liquidity. Now drop down to the 15-minute chart. During that attack, the market created a bullish 15-minute order flow leg. So initially, the bullish FVG inside that leg is a potential support area, but watch what happens when price retraces. Price trades into the bullish FVG, and instead of finding support, it keeps pushing lower. The candle closes below the FVG, and this is the moment everything changes. The bullish fair value gap has failed. It now transitions into a bearish inversion fair value gap, or bearish iFVG. The same area that previously represented bullish support can now become bearish resistance. That gives us a completely different trade opportunity. We can now potentially use the bearish iFVG for a short entry. And the immediate draw on liquidity is the swing low of the original order flow leg. But that's only the immediate target. If we believe this liquidity sweep could actually be the beginning of a larger reversal, we need to zoom back out. And when we do, we find another important level. There's a bullish 4-hour fair value gap sitting below price. That becomes the next major target for the short. Price eventually reaches the 4-hour FVG, but instead of finding support, the market continues lower and closes below it. So now the same process happens again. The bullish 4-hour FVG transitions into a bearish 4-hour iFVG. And once that happens, we can use the 4-hour order flow leg to identify the next major liquidity target. In this case, the swing low of the 4-hour leg becomes the draw on liquidity. And notice what we've just done. We started with a bullish order flow leg. The FVG failed. That created an iFVG. The iFVG gave us a reversal opportunity. The reversal then interacted with a higher time frame FVG. That FVG failed too. And now, the higher time frame order flow leg gives us the next major target. This is why order flow legs are so useful. They aren't simply another pattern to put on your chart. They give you a framework for understanding what the market is doing right now. They tell you which direction the current time frame is favoring. They help you filter fair value gaps. They force you to respect higher time frame magnets. They help you identify where a new leg is likely to form. They give you immediate external liquidity targets. And when an FVG fails, they help you understand how that failure can become an iFVG reversal setup. So the next time you see multiple FVGs across your chart, don't immediately ask which one you should enter from. Step back. Find the latest order flow leg. Identify its direction. Find the FVG inside it. Check the higher time frames for stronger magnets. Wait for the market to confirm which level it actually respects. Then drop down and look for the lower time frame order flow leg that forms from that reaction. That's how you move from simply spotting fair value gaps to actually understanding the order flow behind them. And once you start looking at the chart this way, the market becomes much less random. You're no longer trading every FVG that appears. You're following the hierarchy of liquidity, order flow, and time frame strength. And that is what makes order flow legs such a powerful framework for finding the setups that are actually worth trading.